Question 1. An individual who ceases to pay premiums on a whole life insurance policy may choose to convert the cash value into a fully paid-up policy for a reduced face amount. This is an example of which non-forfeiture option? A. Extended term. B. Reduced paid-up. C. Cash surrender value. D. Automatic premium loan. Answer: B. Reduced paid-up. The reduced paid-up non-forfeiture option allows a policy owner to use the existing cash value to purchase a new, fully paid-up whole life policy with a smaller face amount than the original policy. This means no further premiums are required, but the death benefit will be less than what was initially purchased. It's a way to maintain lifetime coverage without continued premium payments, using the accumulated cash value as a single premium for a lower death benefit. Remember, reduced paid-up means you get a reduced death benefit that is paid up for life. Question 2. Which of the following statements about a variable life insurance policy is most accurate? A. It has a guaranteed minimum cash value. B. The policy owner bears the investment risk. C. Policy loans are not permitted. D. Premiums are flexible and can be changed by the policy owner. Answer: B. The policy owner bears the investment risk. Variable life insurance policies offer policy owners the potential for higher returns by investing cash values in a separate account, which contains a variety of investment options like stocks and bonds. Because the cash value and death benefit can fluctuate based on the performance of these underlying investments, the policy owner assumes the investment risk. This means there is no guaranteed minimum cash value, and the policy requires a securities license to sell due to its investment component. Always remember, if variable is in the name, the policy owner usually takes on the investment risk. Question 3. All of the following are common exclusions found in a life insurance policy, except A. Suicide within the first 2 years. B. Death while committing a felony. C. Death due to an act of war. D. Death due to accidental injury. Answer: D. Death due to accidental injury. Life insurance policies are designed to pay out a death benefit for a wide range of causes, including accidental injury, as long as it's not specifically excluded. Common exclusions typically involve high-risk activities or events such as death from suicide within the initial 2-year contestable period, death while committing a felony, or death due to an act of war. An accidental death is generally a covered peril, reinforcing the purpose of life insurance to provide financial protection to beneficiaries. Keep in mind that exclusions narrow the scope of coverage, so anything not specifically excluded is usually covered. Question 4. An insured allows their whole life policy to lapse but then applies for reinstatement within the allowable time frame. Which of the following conditions is typically required for reinstatement? A. The insured must provide proof of insurability. B. The insured must pay a new first-year premium. C. The insured must select a new beneficiary. D. The policy's cash value must be fully withdrawn. Answer: A. The insured must provide proof of insurability. For a lapsed life insurance policy to be reinstated, the insured is typically required to provide proof of insurability, meaning they must demonstrate to the insurer that they are still a good risk, often through a medical exam or health questionnaire. Additionally, all back premiums must be paid with interest, and any outstanding policy loans must be repaid or reinstated. Reinstatement allows the insured to restore their original policy with its original benefits and cash value, without having to purchase an entirely new policy. Remember that reinstatement is a privilege, not a right, and depends on proving you're still a good risk. Question 5. The period of time after the premium due date during which a policy owner can still pay the premium without the policy lapsing is known as the A. Contestable period. B. Grace period. C. Free look period. D. Waiver period. Answer: B. Grace period. The grace period is a specific time frame, typically 30 or 31 days after the premium due date, during which the policy remains in force even if the premium has not yet been paid. If the insured dies during this period, the death benefit will still be paid to the beneficiary, although any unpaid premium will be deducted from the payout. This provision is designed to protect policy owners from immediate policy lapse due to a slight delay in premium payment. It's a safety net to prevent accidental loss of coverage. Question 6. What is the primary purpose of the Medical Information Bureau, MIB? A. To rate and classify individual insurance applicants. B. To detect and deter fraud by collecting and sharing medical information among insurers. C. To conduct medical examinations for life insurance applicants. D. To approve or deny all life insurance applications. Answer: B. To detect and deter fraud by collecting and sharing medical information among insurers. The Medical Information Bureau, MIB, is a non-profit association that collects and shares coded medical information about applicants among its member insurance companies. Its primary purpose is to help insurers detect and deter fraud, prevent misrepresentation, and reduce adverse selection by providing a reliable source of previously reported medical information. The MIB does not make underwriting decisions itself, but rather serves as an information exchange to help insurers identify discrepancies in applications. Think of it as a central database that helps insurers get a more complete picture of an applicant's medical history. Question 7. Which policy provision states that the application and the policy document constitute the entire contract between the policy owner and the insurer? A. Incontestability clause. B. Entire contract clause. C. Insuring agreement. D. Conformity with state statutes. Answer: B. Entire contract clause. The entire contract clause, often referred to as the entire contract provision, stipulates that the insurance policy itself and the application, along with any attached riders or amendments, form the complete and sole agreement between the policy owner and the insurer. This means that nothing outside of these documents can be considered part of the contract, preventing either party from introducing unwritten statements or promises into the agreement. It protects both the policy owner and the insurer by clearly defining the terms of coverage. This clause ensures there are no hidden terms. Question 8. A policy owner has irrevocably assigned the rights of their life insurance policy to a bank as collateral for a loan. This type of assignment is known as A. Absolute assignment. B. Collateral assignment. C. Vested assignment. D. Partial assignment. Answer: B. Collateral assignment. A collateral assignment is when a policy owner assigns some or all of their policy rights to another party, typically a creditor or bank, as security for a debt or loan. In this scenario, the assignment is temporary and conditional. If the debt is repaid, the policy rights revert to the policy owner. An absolute assignment, conversely, transfers all policy rights permanently to another party. A collateral assignment acts like collateral for a loan, giving the lender a claim to the policy's value only to the extent of the outstanding debt. Question 9. Which of the following is true regarding a life insurance policy's cash value? A. It is only found in term life policies. B. It grows on a tax-deferred basis. C. It is typically available only upon the insured's death. D. It is equal to the face amount of the policy. Answer: B. It grows on a tax-deferred basis. The cash value component of a permanent life insurance policy, such as whole life or universal life, accumulates over time and grows on a tax-deferred basis, meaning the interest earned on the cash value is not taxed until it is withdrawn or the policy is surrendered. This cash value can be accessed by the policy owner during the insured's lifetime through policy loans or withdrawals, and it is distinct from the death benefit, face amount. Term life policies, by contrast, do not build cash value. This tax-deferred growth is a significant benefit of permanent life insurance. Question 10. A policy owner wants to ensure that the death benefit of their life insurance policy will be paid out to their spouse in regular payments over a specific period, rather than as a single lump sum. Which settlement option should they choose? A. Interest only. B. Fixed amount. C. Fixed period. D. Life income. Answer: C. Fixed period. The fixed period settlement option allows the beneficiary to receive the death benefit in equal installments over a predetermined number of years, with both principal and interest being liquidated over that period. This ensures a predictable income stream for a set duration. In contrast, fixed amount pays a specific dollar amount until the funds are exhausted, interest only keeps the principal intact and only pays interest, and life income provides payments for the beneficiary's entire life. If the goal is payments over a specific period, fixed period is the key. Question 11. Which life insurance rider pays the premium if the insured becomes totally and permanently disabled? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Payer benefit rider. Answer: C. Waiver of premium rider. The waiver of premium rider is a valuable benefit that ensures the life insurance policy remains in force if the insured becomes totally and permanently disabled. Under this rider, the insurer will waive all future premiums for the duration of the disability, preventing the policy from lapsing. This rider is crucial for protecting the insured's coverage during times of unexpected financial hardship due to disability. Remember, waiver of premium means the insurer waives or excuses your premium payments if you become disabled. Question 12. All of the following are characteristics of term life insurance, except A. It provides coverage for a specific period. B. It builds cash value over time. C. It is generally less expensive than permanent life insurance initially. D. It pays a death benefit only if the insured dies during the specified term. Answer: B. It builds cash value over time. Term life insurance is designed to provide coverage for a defined period, or term, such as 10, 20, or 30 years. It is typically less expensive than permanent life insurance initially because it does not accumulate cash value and only pays a death benefit if the insured dies within the specified term. Permanent life insurance, like whole life, is the type that builds cash value over time, providing a living benefit. Think of term as temporary protection without savings, and permanent as lifelong protection with a savings component. Question 13. An insured purchased a life insurance policy 5 years ago and intentionally misrepresented their age on the application. Upon the insured's death, what action will the insurer likely take? A. Deny the claim and return all premiums paid. B. Pay the death benefit in full, as the contestable period has passed. C. Adjust the death benefit to what the premium would have purchased at the correct age. D. Pay only the cash surrender value of the policy. Answer: C. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age or sex provision in a life insurance policy dictates that if the insured's age or sex was misrepresented, the insurer will adjust the death benefit to the amount that the premium paid would have purchased at the correct age or sex. This provision applies even after the contestable period because age and sex directly impact the premium calculation and actuarial risk. It ensures fairness by adjusting the benefit rather than denying the claim entirely. This is why accurately stating your age on an application is so important. Question 14. Which type of life insurance policy is characterized by flexible premiums and flexible death benefits, allowing the policy owner to adjust coverage and contributions over time? A. Whole life. B. Term life. C. Universal life. D. Variable whole life. Answer: C. Universal life. Universal life insurance is known for its flexibility, allowing policy owners to adjust both their premium payments and their death benefit within certain limits. Unlike traditional whole life, which has fixed premiums, universal life allows for scheduled or unscheduled premium payments, and the policy owner can also increase or decrease the death benefit, with proof of insurability for increases. This adaptability makes universal life a popular choice for those whose financial needs may change over time. Think of universal as encompassing a wide range of premium and benefit options. Question 15. The right of a policy owner to return a newly purchased life insurance policy within a specified number of days for a full refund of premiums is known as the A. Grace period, B. Reinstatement period, C. Free look period, D. Contestable period. Answer: C. Free look period. The free look period, also known as the 10-day right to examine, in many states, allows a new policy owner a specific number of days, e.g., 10, 20, or 30 days, depending on the state and policy type, to review their policy after delivery. If they are not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid. This provision is designed to give the policy owner time to ensure the policy meets their needs without financial penalty. It's your opportunity to fully review the policy without commitment. Question 16. What is the primary purpose of a buy-sell agreement in business insurance? A. To provide a retirement income for business owners. B. To fund the purchase of a deceased partner's or shareholder's interest in the business. C. To protect the business against lawsuits from employees. D. To pay off the business's outstanding debts. Answer: B. To fund the purchase of a deceased partner's or shareholder's interest in the business. A buy-sell agreement, often funded by life insurance, is a legal contract among business partners or shareholders that dictates how a partner's or owner's share of the business will be transferred if they die, become disabled, or retire. Life insurance policies are commonly used to fund these agreements, providing the necessary cash to buy out the deceased owner's interest from their heirs, ensuring business continuity without financial strain. It's a crucial tool for business succession planning. Question 17. Which of the following statements about the incontestability clause in a life insurance policy is true? A. It prevents the insurer from denying a claim due to any misrepresentation after a specified period, usually 2 years. B. It allows the insurer to contest the policy at any time if fraud is discovered. C. It guarantees that premiums will never increase. D. It applies only if the insured dies during the grace period. Answer: A. It prevents the insurer from denying a claim due to any misrepresentation after a specified period, usually 2 years. The incontestability clause, typically a 2-year period from the policy's issue date, prevents the insurer from denying a claim based on misrepresentations or concealments made in the application once this period has passed, even if the information was fraudulent. However, it does not apply to non-payment of premiums or misstatement of age/sex. This clause provides a sense of security to policy owners that their policy won't be challenged indefinitely. It essentially says the insurer has a limited time to contest the validity of the policy. Question 18. Under which type of life insurance policy is the death benefit considered a level death benefit, meaning it remains the same throughout the policy's duration? A. Decreasing term. B. Whole life. C. Increasing term. D. Universal life. Option B. Increasing death benefit. Answer: B. Whole life. Whole life insurance is a type of permanent life insurance that provides a level, fixed, death benefit for the entire life of the insured, as long as premiums are paid. The death benefit does not increase or decrease, and it is guaranteed to be paid upon the insured's death. In contrast, decreasing term insurance has a decreasing death benefit, while increasing term and universal life option B have death benefits that can increase over time. Whole life implies coverage for your whole life, with a stable, predictable death benefit. Question 19. An individual needs a large amount of life insurance coverage but has a limited budget. Which type of policy would typically provide the most coverage for the lowest initial premium? A. Whole life. B. Variable universal life. C. 20-pay life. D. Level term. Answer: D. Level term. Level term life insurance typically offers the highest death benefit for the lowest initial premium compared to other types of life insurance. This is because it provides coverage for a specific period only, does not accumulate cash value, and the premium remains level for the duration of the term. Whole life and variable universal life policies build cash value and are generally more expensive, while 20-pay life is a type of whole life where premiums are paid for a limited time but still more costly than term. If budget is the primary concern for maximum coverage, term insurance is usually the answer. Question 20. Which of the following is an example of insurable interest in a life insurance policy? A. A neighbor taking out a policy on their neighbor's life. B. An individual taking out a policy on their own life. C. A former employer taking out a policy on a previous employee. D. A casual acquaintance taking out a policy on a friend's life. Answer: B. An individual taking out a policy on their own life. Insurable interest exists when the person applying for the insurance would suffer a financial or emotional loss if the insured person were to die. The most common and clearest example of insurable interest is when an individual takes out a policy on their own life, as they have an inherent interest in their continued well-being. Other examples include spouses, close family members, or businesses with a key employee. Without insurable interest at the time of policy inception, the contract is generally considered a wagering contract and is unenforceable. Question 21. When a life insurance policy is surrendered for its cash value, how are the proceeds typically taxed? A. All proceeds are tax-free. B. The portion of the proceeds exceeding the premiums paid is taxable as ordinary income. C. Only the original premiums paid are taxable. D. The full cash value is taxable as a capital gain. Answer: B. The portion of the proceeds exceeding the premiums paid is taxable as ordinary income. When a life insurance policy is surrendered for its cash value, the amount received that exceeds the total premiums paid into the policy, the cost basis, is considered taxable income. This gain is generally taxed as ordinary income, not as a capital gain. The premiums paid themselves are considered a return of capital and are not taxed. This means you won't be taxed on everything you get back, only the profit you made from the cash value growth. Question 22. Which non-forfeiture option provides temporary coverage for the full face amount of the policy? A. Cash surrender value. B. Reduced paid up. C. Extended term. D. Automatic premium loan. Answer: C. Extended term. The extended term non-forfeiture option allows the policy owner to use the policy's cash value to purchase a single premium term policy for the same face amount as the original policy. This term coverage will last for as long as the cash value can support it, effectively providing temporary coverage at the original death benefit amount. It's often the default non-forfeiture option if the policy owner doesn't select one. It extends your coverage for a term for the same face amount. Question 23. An insured dies, and the beneficiary chooses the interest-only settlement option. What will the beneficiary receive? A. A lump sum payment of the death benefit. B. Regular payments for a specified period until the funds are exhausted. C. Periodic payments of only the interest earned on the death benefit, while the principal remains intact. D. Payments for life, based on the beneficiary's life expectancy. Answer: C. Periodic payments of only the interest earned on the death benefit, while the principal remains intact. The interest-only settlement option means the insurer holds the death benefit proceeds and pays the beneficiary only the interest earned on that principal amount at regular intervals. The principal, the death benefit, itself remains untouched and is typically paid out as a lump sum at a later date, often upon the death of the primary beneficiary, or at a predetermined future time. This option provides income while preserving the original capital. Question 24. What is the typical effect of taking a loan from a whole life insurance policy's cash value? A. The policy terminates immediately. B. The loan is tax deductible. C. The outstanding loan amount reduces the death benefit payable upon the insured's death. D. Interest is not charged on policy loans. Answer: C. The outstanding loan amount reduces the death benefit payable upon the insured's death. When a policy owner takes a loan against their whole life insurance policy's cash value, the policy remains in force, and interest is charged on the loan. If the insured dies before the loan is repaid, the outstanding loan amount, plus any accrued interest, will be deducted from the death benefit paid to the beneficiary. Policy loans are not taxable income, and repayment is generally flexible. This is why it's important to understand that a policy loan reduces the net payout to your beneficiaries if not repaid. Question 25. Which of the following best describes the human life value approach to determining the amount of life insurance needed? A. It calculates the amount of insurance based on the insured's current assets and liabilities. B. It focuses on covering specific needs like mortgages, education, and funeral expenses. C. It estimates the present value of the insured's future earnings. D. It determines the amount of insurance based on the number of dependents the insured has. Answer: C. It estimates the present value of the insured's future earnings. The human life value approach is a method used to determine the appropriate amount of life insurance by calculating the financial loss that would be incurred by the family due to the premature death of the insured. This calculation typically involves estimating the insured's future earning capacity and then discounting it to its present value. It focuses on replacing the income stream the insured would have provided, rather than covering specific expenses. Think of it as putting a financial value on an individual's lifetime income potential.